Hello students, in the present lecture we are going to discuss introduction to goods and services tax. Under it we are focusing classification of GST, composition of GST. Firstly, we are focusing on classification of goods and services. We learned definition of goods. Also we learned definition of service. Firstly, we concerned with classification of goods. Classification of goods under the GST regime shall be done according to HSN. HSN means Harmonized System of Nomenclature. A code shall be allotted to each commodity, and such code shall be mentioned on the invoice issued by the taxable person. Invoice issued by taxable person having HSN, that is Harmonized System of Nomenclature, that HSN is on invoice. So every commodity is allotted HSN. Taxable person having turnover less than rupees 1.5 crore shall not be required to mention the HSN code in their invoice. That is very important. The taxable person having turnover less than 1.5 crore shall not required to mention the HSN code in their invoice. But taxable person whose turnover is above 1.5 crore but below 5 crore shall use 2-digit HSN code in their invoice. It means that turnover between 1.5 to 5 crore, the taxable person has required to mention HSN code on their invoice having 2-digit. The taxpayers whose turnover rupees 5 crore and above shall use 4-digit HCN code in their invoice. We are looking classification of goods. In case of goods, the taxpayers having turnover more than 5 crore shall use 4-digit HSN 4-digit HSN code on their invoice. In case of imports and exports of goods, HCN code of 8-digit shall be compulsory. This is the classification of goods. On the basis of classification of goods, we can say that if the turnover is below than 1.5 crore, there is no need to mention HSN code. If the turnover is in between 1.5 to 5 crore, it is necessary to mention HSN code having 2-digit. If the turnover more than 5 crore, it is necessary to mention HSN code having 4 digits. But in case of import and exports of goods, HSN code of 8 digit, and it is compulsory. Now we are looking classification of services. A new scheme of classification of services has been devised wherein the services of various descriptions have been classified under the various sections, headings, groups. Each group consists of various service codes, that is TRAPI. Services under GST regime shall be classified as per Services Accounting Code SAC. It is 8-digit code for which first 2 digits is 0. In case of classification of services, SAC Services Accounting Code is very important, and it is of 8 digit, of which 2 digits is 0. So we seen that for classification of goods, HSN code is important. For classification of services, SAC is important. Another part, composition scheme under GST. A simplified scheme, which is known as composition scheme, is available to taxpayer if his aggregate turnover of the preceding financial year does not exceed rupees 1.5 crore. Composition scheme is available to taxpayer having turnover less than 1.5 crore. However, in the case of Arunachal Pradesh, Manipur, Meghalaya, Mizoram, Nagaland, Sikkim, Tripura, Uttarakhand, this limit is 75 lakh. This scheme is optional. It is not compulsory. This is optional to taxpayer having turnover less than 1.5 crore. But the scheme is not available to supplier of services except in few cases. Generally, this scheme is available for goods and to services to some extent. Further, the scheme is not available to the manufacture of certain goods, though it is related with the goods, but this scheme is not available to manufacturing industries which are working in ice cream, pan masala, tobacco products. A dealer optioning composition scheme cannot make inter-supply. Inter-supply means supply between two states. No input tax credit available to composition dealers. This is about composition scheme under GST. Moreover, a dealer under composition scheme is not eligible to supply goods through an e-commerce portal. That type of dealer who adopted composition scheme does not eligible for supply of goods and services by adopting e-commerce portal. A person who is under composition scheme is not allowed to charge GST in his invoice. However, for providing relief to small businesses making intrastate supplies, a simple method of paying taxes according to thereof is also prescribed, known as composition levy. This scheme is mostly useful to small businessmen and for making intrastate supplies. Such a person will have to pay tax on his turnover out of his pocket as follows. For manufacturer 1%, 1% of the total turnover. For trader 1% of the total turnover, and supplier of goods and drinks 5%. So this is the composition scheme which is applicable, useful for the taxpayers or small businessmen having turnover less than 1.5 crore. They have not required to pay GST separately by considering the slab rates, but they are required to pay tax on the basis of their turnover. If the turnover is less than 1.5 crore, a manufacturer who adopted this scheme has required to pay 1% tax. Trader has also required to 1% tax, and supplier of goods and drinks have required to pay 5% tax. No input tax credit is available to the person who gets supply of goods services from a dealer under composition scheme. That is very important. A person optioning for composition scheme is required to file quarterly GST return. It means that a person adopting composition scheme has required to file quarterly GST regime. Turnover not more than 50 lakh for preceding year. The alternative composition scheme is available to registered persons whose aggregate turnover in the preceding financial year is rupees 50 lakh. That is very important, or less. Alternative composition scheme is applicable to taxpayer or persons having less than 50 lakh turnover. Not applicable to persons covered by composition scheme. There are two schemes. One is composition scheme and another is alternative composition scheme. Composition scheme is for composition scheme, a taxpayer eligible whose turnover does not exceed rupees 1.5 crore. But alternative composition scheme is eligible to persons or taxpayers having less than 50 lakh turnover. The alternative composition scheme applies to registered person only if he is not eligible for composition scheme. It means that only anyone composition scheme shall be selected by the taxpayer on the basis of their turnover. Ineligible person. The registered person who wants to avail of the benefit of alternative composition scheme should not be engaged in making and supply which is not leviable to GST. It means that those things which are exempted from GST or which are covered under negative list, that type of supply is not, that type of supply making by taxpayer is not eligible under this alternative composition scheme. Should not be engaged in making interstate outward supply. Interstate outward supply should not be casual taxable person or non-resident taxable person. These are the criteria for ineligibility for alternative composition scheme. Should not be engaged in making supply through e-commerce operator who is liable to TDS under section 52 and should not be engaged in making supply of few goods, that is ice cream and other edible ice having HSN, pan masala or tobacco and manufactured tobacco substitutes. Special GST rate 6% under under alternative composition scheme. Special GST rate is 6%. GST is payable under the alternative composition scheme at the rate of 6%, that is 3% central goods and services tax plus 3% state goods and services tax. So up to this stage we discussed the classification of goods, classification of services, then later on we discussed the composition scheme under GST. Then we discussed the alternative composition scheme under GST. Now I would like to focus on framework of GST as introduced in India. Now we are going to learn framework of GST in India. GST has been implemented in India on a dual structure basis, that is central and states shall have concurrent powers to levy, collect and administer GST. It means that India has adopted dual structure of GST. GST is charged by central government as well as state government or union territory. The GST system has two components. One component is central GST and another component is state GST or union territory GST. The central GST and state GST or union territory GST would be levied simultaneously on every transaction of supply of goods or services or both, except the supply and the transaction which are up to the prescribed threshold limits. GST extends to whole of India. It is applicable, GST is applicable to whole India. Now we are considering central GST. The framework of GST is in India of two types, that is central GST and state GST or union territory GST. Central GST, that is GST levied by the central government on intra-state supply of goods or services or both. This central GST is levied on intrastate supply of means supply between two states. goods supplied from Maharashtra to Madhya Pradesh, that is intrastate supply. Goods supply, sorry, goods supply intrastate, that is within the state. GST levied by the central government on intrastate supply of goods or services or both. That is goods supplied within intrastate means goods supply within state. That is goods supply from Pune to Mumbai, goods supply from Nashik to Nagar, that is intrastate supply. Intrastate supply, it means that GST is levied on intrastate supply of goods and services or both. It is collected along with the SGST or UTGST. Center is levying the GST and the state is also levying GST. If the transaction is happened in Union Territory instead of state, Union Territory is levying GST. And the revenues collected are distributed between the state or Union territory and state government as per the method adopted in this regard. For example, if the goods or services are provided within the state of Maharashtra, then along with SGT and CGT will also be collected. Hence, if the goods is supplied within Maharashtra or within only one state, that is on that goods or services or both, two types of taxes levied. Two means here central government and state government. SGST, it means state goods and services tax. State goods and services tax levied by the states on intrastate supply of goods or services or both would be called the state GST. State under the GST law is defined include a union territory with legislature. It means the state according to GST, Central GST Act is there, then state laws are there, then union territory laws are there. Under the state definition, it includes union territory. The transaction of goods and services taken place within the state are charged with GST on the concerned states. Thus, the GST charged by state government is called as SGST. The revenues of these transactions are earned by the state government. Suppose goods manufactured and sold within Maharashtra state, then SGST will be levied and collected by the Maharashtra government. UTGST, it means Union Territory GST, on every supply of goods or services or both within the Union territories of Andaman and Nicobar Islands, Lakshadweep, Dadra, Nagar Haveli, Daman and Diu, Chhattisgarh, etc. Union Territory GST will be levied. The UTGST levied and collected by the Union Territories without state legislatures on intrastate supplies of taxable goods and services. IGST, Integrated Goods and Services Tax. Integrated Goods and Services Tax is collected on goods or services or both transaction between two different states, that is interstate supply. It is levied and collected by the central government. The IGST earner is then divided between the states and the central government. IGST shall be apportioned between central and states in the manner as may be provided in due course by the GST Council. It will happen in case of Union territories also. It is also applied to import of goods or services or both. IGST, Integrated Goods and Services Tax, is levied by the different two states. Number 5. Import of goods or services. Import of goods or services or both. Import of goods or services or both shall be treated as interstate supply and would liable to IGST. That is very important. Import of goods or services or both shall be treated as interstate supply and would be liable to IGST, since GST is a destination based consumption tax. GST is a destination based consumption tax. IGST on import shall be levied and collected by the state in which goods or services or both are finally consumed or used. Export of goods or services or both. Previously we discussed the import of goods or services. Now we are discussing export of goods or services or both. Exports will be treated as zero rates supplies. That is very important. No tax will be payable on export of goods or services or both. However, credit of input tax credit will be available and exporters can claim refund of the same. So, in framework of GST, we learned or we got information about 6 things. Now I am discussing about threshold limit. Threshold limit. Aggregate turnover in financial year up to rupees 20 lakh. Aggregate turnover in financial year up to rupees 10 lakh for special categories states, that is Nagaland, Manipur, Mizoram and Tripura. It means that this is limit. If the aggregate turnover does not exceed rupees 20 lakh, there is no need to consider the provisions as related to GST. This is reduced up to 10 lakh in case of special category states like Nagaland, Manipur, Mizoram and Tripura. So, in this lecture, we learned classification of goods, classification of services, composition scheme, alternative composition scheme, framework of GST and threshold limit. So friends, in this way I am finishing my speech here. Thank you for kindly listening.